Welcome to the deep dive. Today, we've got quite a stack here: market reports, memos, articles, and we're diving right into some major shifts. We're talking finance, big media shakeups, and, well, the speed of tech disruption.
Yeah, it's a real mix. I mean, you've got everything from huge media deals being floated, billion-dollar court rulings, and then this fundamental change in how everyday folks are investing, or maybe gambling.
Right, and our goal today really is to cut through that noise. We want to pull out the surprising bits, the data that tells you who's really gaining ground, who's getting left behind, and what the future might look like for, information and money.
Makes sense.
So let's kick off where things got pretty wild last week, the crypto space.
Oh, yeah. If you were watching, you saw the big names Bitcoin, Ethereum, XRP, just boom, take a nosedive. Fast.
And a lot of that was tied to geopolitical jitters, right? Like these renewed threats about tariffs on China.
Exactly. That seemed to be the trigger. But what's fascinating is how differently people saw that drop. Bitcoin lost, what, $13,000?
Yeah. Sounds huge. To a traditional stock market watcher, that's panic time.
Right. But in crypto circles, that was maybe a 10% move. And honestly, the commentary we saw was calling it a crash for ants.
A crash for ants. Seriously?
Yeah, seriously. Because they're used to seeing these insane drawdowns, like 30%, even 80% in past cycles. That was just normal volatility. If the S&P dropped 10% that fast, it'd be DEFCON 1. Here it's, well,
It's just another Tuesday in crypto.
pretty much. And that volatility, it got cranked up by all the leverage in the system. We saw this huge, instantaneous purge. Something like $19 billion in leverage positions just vanished.
And 19 billion gone.
Poof. And look, for people not deep in these markets, that sounds apocalyptic. But for the veterans, it's almost seen as like a necessary evil.
Or reset.
A total reset.
Yeah.
A system cleanse. When things get too frothy, too leveraged in one direction, these liquidations basically flesh out the weak hands, the bad bets. It clears the decks. It hurts, sure, but it makes the foundation stronger for whatever comes next.
Okay, but then there was that weird story about those hyperliquid accounts.
Oh, yeah, that was something else. Hyperliquid's a decentralized exchange with supposedly no central control.
Right.
Yet you had these two accounts somehow place massive bets against the market literally minutes before the big news hit. And they walked away with, $160 million between them.
How does that even happen? It raises questions, doesn't it, about who knew what, when?
Big time. Was it just incredibly lucky timing? Or did someone have, early vendor data, some inside track on the geopolitical stuff? It definitely muddies the waters on the whole fair information idea in a decentralized system.
But even with all that chaos, the core believers, they weren't selling.
Not the true believers, no, because the whole point, the fundamental idea, is this non-sovereign thesis.
Meaning
Bitcoin is supposed to be outside the control of any single government. So if you're dumping your Bitcoin just because the U.S. and China are rattling sabers, well, you kind of missed the memo.
You're still treating it like a tech stock, not digital gold.
Exactly. You fundamentally misunderstand its purpose if geopolitical games are your sell signal.
Which leads back to how people are actually structuring their holdings, right? That barbell idea.
Yeah, the barbell approach is still dominant for the savvier folks. Yeah. You've got the big, heavy end. Bitcoin. That's your digital savings, your store of value, maybe 90% even more of the portfolio. Relatively stable in crypto terms.
And the other end?
That's the small, risky end. Maybe 10%. That's where you put your Solana, your other altcoins. You treat those like volatile tech stocks, like trades. They're competing tech platforms, essentially.
Okay. And speaking of platforms and strategy shifts, we got to talk about Ripple. They seem to be doing something different.
Oh, it's a massive pivot.
Yeah.
Ripple, the company behind XRP, they're using that huge pile of cash they made from the token to basically buy their way into legitimacy. They're acquiring actual, boring, non-crypto businesses.
Like the Hidden Road deal.
Exactly. They dropped $1.25 billion on Hidden Road. And Hidden Road is basically institutional plumbing, a global credit network for banks and big players.
So moving away from just the token.
Completely. They're transforming a, let's be honest, controversial crypto business model into a diversified, traditional financial infrastructure provider. They're using crypto wealth to build something Wall Street understands and maybe needs. It's pretty clever, actually.
So that's the new guard building bridges. What about the old guard? How are they reacting? We saw Jim Cramer getting pretty anxious.
Yeah, Cramer voiced that fear, didn't he? That crypto is becoming the tail wagging the dog for U.S. stocks.
Meaning money flowing into crypto is pulling money out of equities and dictating market direction.
That's his fear. And it really captures the existential dread setting in for some traditional finance folks. They see stablecoins replacing dollars for transactions. They see these prediction markets becoming, well, maybe the real source of truth.
Oh, okay, let's unpack those prediction markets. Kalshi, PolyMarket, you called them an economic bounty.
Yeah, think about it. Instead of waiting for official reports or media consensus, which can be slow or biased, these markets basically pay people to surface accurate information fast. Well, say you're a supplier, and you have real-time shipping data that tells you Tesla's deliveries are going to beat expectations. You can bet on that outcome on PolyMarket and make money before the official numbers drop. Or if you somehow know the Nobel Prize winner early.
You get paid for putting that info out there via your bet.
Exactly. The cash incentive drives speed and, theoretically, truth. And it's not small anymore. Kalshi's really taken off, partly thanks to that Robinhood deal. They grabbed like 60% market share.
Wow.
And the money involved. PolyMarket reportedly did $1.5 billion in volume in September alone. Even if they only take, say, 2% on net winnings, that's real revenue. Serious money.
But the disruption isn't just prediction markets, it's automation hitting the core of finance, isn't it? The threat to advisors.
Oh, absolutely. We're seeing platforms now that automate investing in ways that were unthinkable just a few years ago.
Like mirroring famous investors.
Yeah, things like autopilot. You can literally set it to copy the public trades of politicians like Nancy Pelosi, or try to mimic legendary secretive funds like Jim Simon's medallion based on their filings.
And the results.
Well, one Pelosi tracker was apparently up nearly 19% since July. A Simon's tracker showed something like 74% over a year. Now, obviously, past performance isn't future returns, but...
But if an AI can do that automatically, why pay a human advisor 1% a year for maybe 6% returns?
Precisely. It makes the human look slow, expensive, and, frankly, less effective. And then you add things like CFO Sylvia.
What's that?
It's an AI agent. You connect your accounts, upload your tax returns, and it can run complex stuff like Monte Carlo simulations, analyze global events like a new trade deal in real time, and give you personalized advice instantly.
Okay, that sounds powerful, but also maybe dangerous. All this democratization of complex finance.
That's the double-edged sword, isn't it? The efficiency is amazing, but it also fuels access to incredibly risky stuff for everyday people.
Like those leveraged ETFs.
Yeah, the rise of things like 5x leveraged single stock ETFs is terrifying.
Explain why the 5x is so risky, quickly.
Because the math is brutal. If you're levered 5x, the underlying stock only needs to move 20% against you, which can happen in a day, easily, and boom, your entire investment is wiped out. Zero.
We saw an example of that with a 3x short AMD fund. Right?
Exactly. AMD rallied, and the people holding the 3x short ETF got completely blown up. There's just no room for error.
And then the zero-day options.
0 day to expiry, or 0 GTEs. Options that expire the same day you buy them. They're now over half of all options traded.
Basically lottery tickets?
Essentially. Insanely high risk, potentially high reward, but expiring in hours. It just guarantees we're going to keep seeing these stories of people losing everything, like that $50,000 portfolio mentioned in the sources, just gone in an afternoon.
Okay, shifting gears to media, another area where big money is moving fast. The Ellisons.
Yeah, David Ellison, Skydance. It's about $1 billion revenue company, right? They just bought Paramount, CBS, MTV, BET, all that for $8 billion. Huge deal. But that was just the appetizer, it seems.
Because then they immediately went after Warner Bros. Discovery.
Made a bid, yeah. Now, WBD is much bigger, $42 billion market cap, though carrying a ton of debt, like $35 billion plus.
And the bid was rejected.
The initial $20 share offer was apparently last off as way too low. But it shows the ambition, right? David Ellison clearly wants to build a global media giant.
And he's got the backing.
He's got the ultimate backing. His dad, Larry Ellison, net worth pushing, what, $370 billion. Yeah. Larry's already involved in media. Remember the TikTok deal? He was part of that $14 billion valuation play.
So it's David's hunger plus Larry's basically infinite capital.
That combination makes them arguably the most aggressive force in media consolidation right now. They're not nibbling. They're trying to swallow competitors whole.
And while ownership consolidates, the way people watch is changing too. That Spotify-Netflix deal?
Yeah, putting video podcasts on Netflix seems small, but it's significant. Because the data shows people are watching video podcasts on their TVs. It's the second biggest source of views after phones. So if you make a video podcast, you're not just competing with other podcasts anymore.
You're competing with Netflix shows for that living room screen time.
Exactly. So Spotify partnering with Netflix gets their content, like the Ringer stuff, directly onto that battleground. It's about meeting the audience where they are.
And this innovation just throws the struggles of older media companies into sharp relief, doesn't it?
Oh, absolutely. Look at iHeartMedia, used to be Clear Channel, still pulls in nearly $4 billion in revenue. Sounds okay,
Yeah,
great.
debt.
But the debt is crippling, over $5 billion. So the market value is tiny, like $400 million.
Yeah.
It's basically a zombie. Huge revenues, massive debt, no growth prospects. The market just punishes that relentlessly.
Okay, one last area, culture, speech, and, well, massive judgments. The Alex Jones situation.
Right. The Supreme Court said no to his appeal. So that $1.4 billion defamation judgment for the Sandy Hook lies, it stands.
But the number itself,
Yeah.
$1.4 billion.
It's almost symbolic, isn't it?
Yeah.
I mean, his net worth before all this was estimated at maybe $20–40 million. He's never going to pay that full amount.
So what's the real takeaway there?
It's about what currency actually matters in today's media landscape. And increasingly, it seems like it's loyalty and virality, not necessarily traditional trust or even apparently financial solvency.
You mean like the J.D. Vance and Stephanopoulos thing?
That's a perfect example. Stephanopoulos cuts Vance off,
Yeah.
tries to control the narrative. What happened?
Trump backs Vance, snubs ABC.
Right. That act reinforces Vance's standing with his base loyalty. And the clip itself, the contentious part, it goes viral. It gets maybe 5 times the views the original interview segment did.
So the network's attempt to frame it backfired.
Massively. The viral clip became the message, regardless of ABC's intent. That reach, that amplification driven by loyalty is often worth more now than playing nice with networks whose own trust scores are, frankly, falling.
Wow. Okay, so wrapping this all up, it's been a whirlwind. We've seen AI coming for financial advisors, the rise of this supercharged retail trader, and just immense consolidation of media power by, well, billionaire families.
Yeah, and the thread connecting all of it is just speed and ruthless efficiency. The market is rewarding agility and punishing bloat. Think iHeart's debt. Think Wall Street's slow settlement times. Think advisors' fees. Anything slow, expensive, or inefficient is getting hammered.
Yeah.
Disruption isn't just happening, it's accelerating.
So here's the final thought to leave you with. Retail trading volume is now neck and neck with institutional volume. This new breed of retail trader, maybe we call them pro-tail, they want the 5x leverage. They trust prediction markets over headlines. So what do regulators do? Do they try to protect the old guard, the big banks, the established systems, or are they eventually forced to just accept this new reality? To regulate the high-speed, high-leverage game the dominant players are already playing, whose rules are going to win out? Something to think about.